Hey everybody, it's Bob here, undisclosed location. Got my good friend Phil here. Hey guys, they couldn't have scripted this better in Hollywood. October the 13th, Freddy Krueger is alive. We'll tell you all about it.
Trade Genius.
Okay, Phil, you warned us about October 13th. Let's get that gap filled. They couldn't get the gap fill on SPY. And then the bond market is starting to puke up here. And you have an interesting set of charts and data to show that the Fed is doing this on purpose. They want to puke out. I'm going to throw it back to you.
Right. So it's interesting because, we've been saying that, TLT ultimately is going to be a buy, right? And we're looking for a long-term pickup on that for a long swing trade. But, you also have to kind of be adaptable to what's going on in the market. And there's a lot of things changing week to week and even on a global scale, right? With all of the armed conflict that we were dealing with over in the Middle East now. So what's going on? Well, we were getting comments, the Fed speakers are always out every week speaking at some conference or some event. And here, notice what was said this week. Now on October 10th, Kashkari, who's on the Fed board, said it's possible that higher bond yields could leave less for the Fed to do, implying that if yields continue to grind up, meaning that the bond demand is low, that they may not have to raise rates. Then Collins chimes in. He came in yesterday and said the Fed is at or near peak of rates hike cycle. So they do this. They ease us into what the narrative is going to be for them, right? And then he said bond yield rises are likely to reduce the need for a near-term Fed hike. So second time now we're hearing that, hey, let's let the bond market do the heavy lifting for us, because they are starting to introduce what I would say systemic stresses from these hikes. And I think they're basically out of runway in terms of what the system can handle in terms of hike. This isn't the 70s and Volcker can raise, 3% on one meeting. We have way too much leverage in the system now and things will break. So we can't do that. So they're shifting here and they're saying, hey, the bond market can handle it. So now we have this kind of narrative coming out from them. Notice what happened now in the last two bond auctions, Bob. We had auctions on the 11th and the 12th. The Fed bids for 10-year notes total zero. They bid nothing, Bob. And then on the 30-year auction yesterday, which introduced the big volatility, the big drop, zero. So all of a sudden now, Fed's not there at the auctions participating. And yes, we're in a QT environment and they're tapering off their bond program, purchasing program. They still roll debt though. So it doesn't mean that they're completely like walking away from the bond market. However, what they're telling us now is don't expect us to show up much at all anymore at these bond auctions. Now that means this market needs to stand on its own and support this bond market. And I think the Fed is implying to us that they're expecting that not to be the case and that yields are going to stay elevated for higher because of the bond market. So then, okay, now what? So I think we run into a situation, Bob, and we got to discuss this and look at the charts, specifically TLT now, and see what's the game here. Because if you're an institutional investor and you don't have the support of the Fed there anymore, and they're saying, let's let the market take care of itself, then, who's going to be the first to jump in the pool here is my take on this, Bob. And I want to get your take, and then we're going to jump into the TLT charts.
Yeah, so, who has to jump into the pool are the bond bankers. There's no such thing as a failed treasury auction. It's that the banks have to buy, and when the banks buy, they can pick the rate they buy at. That's why we blew out so hard yesterday. So yeah, TLT just follows along. It's just a derivative. So I was surprised though, we're talking here Friday morning that TLT got such a bid here this morning. But at this point, if this keeps up, Phil, we get 10-year over 10 or 5%. TLT's down around 80 or so. And I think what happens, what's more importantly, is the CDSs, they become infinite insurance for the banks. Basically, the banks are uninsurable. And I don't think the Fed's going to allow the banks to be exposed like that without insurance. So they're going to force some sort of action to drive money out of the stock market into this bond market, one way, shape, or form. And I guess the longer this Israeli conflict goes, if it keeps getting incrementally more intense, people may say, hey, I need to get into these treasuries and get out of my risk assets. So that's kind of my view on it. And when you're done with showing these charts here, there's some other things happening in the market that agrees with us that you guys will all like, because I think people have been waiting for this a long time. So back to you, Phil.
All right. So if we look at the TLT, what's going on? This is the big institutional orders that come in. And these orders of this magnitude and this size are the ones that you kind of want to see the reaction from. So what we have now is we keep getting these large orders, and ultimately you don't really know if they're covering a position and closing a position or opening a position. If they're opening a position, then you're looking for a move out of this range. So it's very important now for TLT that we're either going to start breaking up over 87. And then I think that means that these guys were accumulating here between 85.50 and 86.50 or so. Or if we start to fall out of bed and we lose 85.50, then I think we have to now look at the long-term chart of TLT and see where exactly is this thing going. Ultimately, I think the recession trade is going to come in and the banks are ultimately going to start sliding into TLT again because you're going to want that guaranteed return during a recession. However, they could be raising cash in the interim and letting the bond market capitulate to a degree. So there's a lot of things that go on, but if we want, we can go over to the live chart here and take a look at the long-term levels here on TLT. And what you'll see over here is that, currently we're putting in a bullish weekly hammer, and we're in that zone where we were talking about, or at least I was talking about, $88, and that give or take $1 or $2 is kind of the long-term spot that you want to start getting into this TLT trade. If not, though, we have big levels of support at 82.50 approximately, and then 80.50. And the reason for that is way over here on the left, you have these major weekly lows. Okay. So if this market continues to push down, now you're already at the bottom. I got a Bollinger Band up here. You're already at the bottom of a 2 deviation Bollinger Band. All right. That's an extensive move down, especially when you've already stretched it as much as we have here. And essentially you got a dead cat bounce and made new lows. Hey guys, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. So we're pretty oversold in terms of this move and the size and the speed of this move. But you do have these levels out here. So again, you have to look at, I believe, 85.50 to 87. Over 87, this weekly hammer likely holds. And I think you're going to get a push higher. And then yields aren't going to be going up. They'll be going down. However, you also then have to watch equities, because if equities drop while this is happening, then your recession trade's on and you got to run for the hills. And then the safety trade is going to be TLT above all else. TLT might be the best performing asset for a few months here over everything. Otherwise, if not, and the Fed is inferring that they're just going to pull away from the market and the institutional guys aren't going to participate, we start losing that 85.50 level, then you have to be prepared for a drop down to 82 to 80. But if you're building a long-term position, Bob, what can you do to kind of just be like hanging out while this low gets hammered out in terms of like selling options against your TLT position? What can you do there?
Yeah, and that's what I have on right now. So I have a TLT position, and I have actually the strike 87s for the 20th of October. And the way I trade it, Phil, is that I always like to have a covered call on my position until we start getting a weekly trend up. And so I like to sell at Delta 35, and I like to buy them back and roll them if it gets to Delta 80. And so, my position was fine because you had TLT down at $85, and then this morning it just had this big rampathon. So that's what I recommend for people to do, is just don't do it once a week, do it once every 2 weeks. Always look to sell 35 and buy back at 75 or 80. Don't worry about it going into money a little bit. Just look at your TLT. It's up more than your options are against you, because then you'll start getting in and out of trades here unnecessarily. So that's what I would do with TLT. The other thing that's interesting, what normally works is I'm also long energy and oil in particular. And as bond yields have been rising, energy's been rising with it, Phil. And I think now we kind of had a break in some correlations here. We couldn't pull the chart up for you guys, but earlier this week, Phil also saw dark pool buying in silver. And then the oil trade is not acting per the seasonals. We should just be a weak period of oil right now, and it's not. And in fact, oil is very close to, if it breaks out of this, there's just been this cluster of selling in this 87.50 area, down to 84. And if we break over 87.50, it brings, I think we bring back into the 90s again, Phil. And I think the war is only part of the reason. The other thing too is I think Janet Yellen came out and basically said interest rate payments are going to be 1% of GDP for the next 10 years or greater. And people are like, hey, we got to protect ourselves from this inflation that's coming. But it's not just that. Today, gold, silver, the miners all blew out. And one thing too, and I know I'm jumping around here, what's been all year long is that you buy oil on a Monday close and you sell oil on a Friday close. It's been a very profitable trade. But now oil is being bid on a Friday pretty aggressively. And I think now because we bring geopolitical risk in, it was always a thing is never short oil on a Friday. And I think we're back to that again. The other thing is you never short gold on a Friday and you never stay long SPY on a Friday into Monday. So I think that trade is back on again. I think the world risk trade is back on. And I know you did some scribbles there, Phil. Do you want to kind of walk people through that, your thinking?
Yeah, so on oil, you got to watch this 87.30 to 87.75 area roughly. And if you get this breakout move, especially like if you get that back test, don't be afraid to buy that back test, because I think now you're going to open up and every one of these levels above here is going to be a little reaction and then higher. Because one thing that I noticed when we go into conflict is that you'll get an initial gap up in oil, right? The market's real. It seems like conflicts always pop off on the weekend. I don't know why. It seems that way. Maybe that's a market thing. The central bankers want to create a gap, so they go, okay, go. Start your war. But it happens a lot. You get a gap up and then you get a backfill, okay, of that gap, and then you get buying support come in. That's exactly what's happened here in oil. So it tells me that that plays into a longer term playbook of you start to grind higher and ultimately you're going to go get that initial high that you put in, which is what's happening today. And so I think we have a very aggressive move building here, especially if we can start cracking over this 87 to 88, this 87.75 to 88 level. You crack over that, hold that to support, then watch out. And I think this is building, and you're going to take out this most recent high of 95. I didn't think this was on the table, but global conflict changes all of that, and you have to go with that in the interim until things cool off. And then if things do subside in that, then oil will probably take a break. But until then, you have to stay bullish oil. Yeah, and it's the way they protect themselves. If we get a bond bear and a stock bear, oil is a safe haven. So now they have an excuse to keep oil bid because of the war. The other thing too is Israel has basically said, hey, you guys have 24 hours to get out of Gaza City, and now you have game theory in play because you have Iran, threatening things, and so I think the level of escalation is not done yet, and I think that should unnerve the oil markets and the gas market. We rarely have oil up, gas up. And that's what we have today, Phil. Right. Usually the oil producers, when they get a lot of oil, when they get a big bid in oil, they actually short gas because they basically give that away because it's just a byproduct of their oil drilling. This time we both got bid. And tomorrow we're going to talk natural gas, Phil, and show you why America's cheap natural gas is going to be a forgotten memory and how you could profit from it. It's going to be wild, Phil. Freddy Krueger, man, this is going to be Freddy Krueger market until Halloween, I think. Yeah, we warned of a rocky Q4, and I think we're getting that start. And then real briefly too, since we talked on oil and TLT, the stock market, here's the futures on the S&P 500, and you'll notice I have a marked off 43.81 because I thought this was a key level, and you guys could see how we've reacted to that. It was a sticky level here, and then we lost it. We came up, it acted as resistance here. We popped over it, held as support, and then we made a high until we got the drop yesterday, and then now we're back under it again. We popped briefly over it this morning. The consumer sentiment came in, big miss on that, and dropped us back under. So most likely what we're going to do is get a return trip down here to the 200-day moving average, which is in yellow here, and that takes us back down to 43.40. I think ultimately though, we're going to probably test 4,300, which is a big support resistance level. And if you lose 4,300, guess what? You're going to attack these lows. I think that's still in play, and I think we're bearish at least until through November, guys. And so, brace yourself for volatility. Right now, we have to be observant on how the bond market and equities behave, because if they diverge and bonds go bid at some point here and equities don't, we're taking out 2022 lows.
For sure. Hey guys, thanks for listening. If you want to trade with us, go to tradelikeagenius.com. We have specials running. Our indicators got us out of that trade. I was traveling, so I missed the move down, but it warned us that something was going to happen here in the bond market. Then auction confirmed it. And so we have really good tools to help you not be surprised by the market. Remember, the news is just confirmation of the market action, not the other way around. I'll see you guys tomorrow. Hit like, subscribe, and tell your friends about us. We think we have a pretty good understanding of what's going on here.
See you guys later. Take care.
Trade Genius.